Hey guys, it's Chase with Everbullish, the Stock Sherpa on YouTube. I am the owner and professional investor and portfolio manager for Everbullish.com and the Everbullish Substack. So if you like this, go subscribe. This is beginner lesson 7, lucky number 7, and this is where we're really going to start gaining traction on how I've affected my process to be almost perfect when it comes to investing. So here you go. Okay. We've went over this a million times. I know y'all are tired of it, but this will be the last time we show the Morningstar style box, and then we're going to move on to the true key, everything you need to pick the best stocks in the best sectors at the best time to make the best profits. But just in review, we have dividend stocks, we have blend stocks, we have growth stocks. This would be the entire market, not just the S&P 500. This would be what's called the total market, and you can invest in the total market where you own like 4,000 different stocks, but most of them are below 1% and like just pennies, which doesn't make sense and it wastes your opportunity cost, right? But as an example, this is how everybody does it. No one doesn't start like this. The law or FINRA, which is the organization that governs how people give investment advice, are stuck in this modern portfolio theory. That's what part of this is called. And that was invented in the 40s, and it never really worked. All it did was keep investors' money staying in average to a little bit above average performance so they could charge you more fees. They're not trying to make you the most money. That's what I do. Okay, so we have large companies. We have dividend or value is what this really stands for, so I always just write dividend around it. We have blend stocks. So blends are companies that have a little bit of growth. They want to make a profit. They want to pass some of that profit through to their investors, but they want to reinvest most of it in more profits, right? And then we have growth. So I'm going to go through every box here, and I'm going to tell you why this is a really antiquated and bad way to invest, and that your money is literally and certainly invested like this if you have a 401k, if you have an IRA that has mutual funds, and even if you just have a portfolio manage yourself. You're not necessarily going to be in the spot where this is going to be all right. So I need to show that. First box, large value. So this is dividend payers. This is stocks that have been around forever. These are stocks that are done growing. They don't really want their price to go up that much. They'd rather give a dividend back to you as an investor. Most of the time it's 2 to 4%. I can find the ones that are 7 to 8%, and I do that and send it out. But just as an example, United Health, JP Morgan, and Cisco Systems, right? So a giant healthcare company that's been around since the 50s or 60s. It was named something different. JP Morgan, a bank that's been around for almost 300 years. And then Cisco Systems. This is not the food company. This is the software company. So we get that, right? These guys are going to give you a little bit of dividend, but they're not going to grow at all. They're not even trying to grow at all unless you reinvest the dividends. A blend company is like a Wells Fargo, or everybody knows this one, and if you don't, this is a good lesson. So this is Berkshire. Berkshire Hathaway is the name of the company. They have many other share classes. They have B shares as well, which are a bit more affordable. I haven't even checked, but I think that these are like, one share of Berkshire should be like in the 140s if I were to look. But just think about this as Buffett. This is Warren Buffett, the man himself, the Oracle of Omaha, and this is what his investment company is because it owns everything, right? Berkshire owns real estate companies, they own mining companies, they own textile manufacturing companies, they're all stratified. That's why they're in the middle here. That makes sense, right? And then on the growth side, this is what anybody under 50. So we're going to say U55 actually. Anybody under the age of 55, you're wasting your money by putting it right here in today's market. Now, as the market changes, we're going to shift some over here, right? But currently, a stock that I always like to tell people about to describe this is it's Apple, man. We know it goes like this over time, and we love that profit, right? So it's going to go up. You're going to be able to buy it at 1,000 and sell it at 2,000, right? Just like if you were buying a car or a house or anything else. Now, the best the best mutual fund company, which I know from being in the business for large cap growth, is Fidelity. There's a bunch of Fidelity large cap growth funds. The most popular and famous is called the Contra Fund. And I've made all my friends and family millions of dollars using that, right? And you can do that for yourself. It's just a fund, but it's far from perfect, especially the way we're going to invest. Going back to the dividends real quick, JP Morgan, and I only know this from working forever and having over 10,000 funds to offer. JP Morgan makes the best portfolios of these stocks. I don't want you to own the portfolio. I want you to buy the best damn stock that there is in that sector, right? And well, actually not sector, in the style. All right, we're gonna move down. I'll take a lot less time. SKX is Skechers. So this is a medium company. They don't make more than 2 billion profits in a year, right? So basically, Skechers is a small, it's not Nike, right? It's not Doc Martens. It's not, Converse or Adidas. It's Skechers. They make good shoes. They do what they do. But as an example, that's a smaller size or a medium size shoe brand. Principal Financial, insurance company. You're going to find a lot of insurance companies and regional banks over here. 3 years ago, we made a ton in the Cincinnati Regional Bank. I felt bad about that one because there's just it was really just a pick that made a mint and doubled in a year. But there's going to be small regional banks. Unfortunately, those don't really exist anymore, and you have to dig and look to find the ones that are good. Check this out one. So this one is D.R. Horton, right? A home manufacturer, right? If the real estate market is looking good, kind of like it is now, with a lower interest rate environment, or a expected lower interest rate environment, that falls down, or that goes up rather, as rates fall. So maybe this would be a good stock. I don't know. You tell me. I do know. Just go buy my portfolio. This is Allstate, again, another insurance company. So we've got Principal and Allstate. And this is United Rentals. They're not U-Haul. They're not Penske. They're not one of the big movers and shakers like DHL, right? They're just a medium-sized $2 billion company or less that does rentals. It kind of makes sense, hopefully. This is my favorite one on here, Palantir. As a perfect example, Palantir, I just sent an article about it, moved up to here. It got so big, and the stock price, which is the only thing that matters on a chart like this, is the stock price and the shares that's outstanding. That just means how big is the freaking company, right? So Palantir just moved up, and that is one of my portfolio picks for next year. So go buy the portfolio, you'll see it in there. The Trade Desk, shout out Sam, my old roommate and buddy at Fidelity. Sam told me about this stock, and it's one of the only few tips I didn't take because he was so much younger than me and I thought I knew everything. And although I knew a lot, this was just happened to be a good pick. So that's called the Trade Desk. So it's a medium-sized brokerage company, right? And then we have FICO. This is a funny one. So FICO, y'all all know that word. That word comes from Fair Isaacs Corporation. And that was originally a company from Ben Franklin. It goes all the way back there. So Fair Isaac Corporation is FICO. They think about how much money they can make by just telling banks whether or not you're worthy of a loan, or telling employers whether or not you have good credit or bad credit, which I hate, and all the other things that go into a FICO score. They make enough money to be a $2 billion company. Isn't that crazy? And then moving down here, see if I can zoom this in. Yeah, there we go. We're going to start with the boner pills, guys. This is Hims. It's actually called a corporation called Him and Hers, and they make health products over the phone, online, prescription from anywhere from antidepressants, but mostly they're just used for Cialis and Viagra. They sell a generic version. Not that I would know anything about that. So you have Hims and you have SG. This is a good example. I always like to use restaurants. So as a restaurant, this is Sweet Greens. Have you ever been to a Sweet Greens? There's one in downtown Austin that's in the middle of this trendy health kind of hub of the town, and it's delicious. They sell salads and salmon and whatever you want, right? FMC Corporation, I used to manage the customers of that corporation, which is why I put it on here, but these are the people that make vending machines all the way to aerospace products. If you're ever walking onto an airplane, you know that like tunnel that you go through that gets you there, the catwalk or whatever you'd call it, they make those. They make oil supplies, they make everything, right? So they're a stratified company, so they're growth and blend. And then this is Bath and Body Works. If y'all remember, maybe if you're a girl or somebody that really enjoys those type of products and you want to support a company that does that, now you know that Bath and Body Works Incorporated is a blend style stock. Hopefully that makes sense. Finally over here, I got KSSI, so it's a value play, right? They don't really want to grow as much as they want to just pay out their customers or their shareholders, right? So this is Kohl's. This is like the low to medium priced JCPenney like clothing option. I'm not sure if they're all over the country, so I'm putting that in there because they are here in Texas. And then EVGO. EVGO is like those slick golf carts that you ride around in if you're on a campus, or like if there's a campus police, if you're at a fairgrounds or an event. EVGO makes those, and they're also making actual electric cars. The kind of cars that they make right now are just around like islands and stuff like that that don't have roads or have bad roads, but that's what they do. Okay, we've got this. But why am I telling you all this? The main thing I'm telling you is that the law and every advisor in the country, most around the world, are fiduciarily bound, which is an excuse, by the way. If you ever hear fiduciary, it means they're just going to charge you money. But they are bound when they start building a portfolio of mutual companies, Vanguard, blah, 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 all the Fidelities, all the Morgan Stanleys, all the Edward Joneses, all the Goldman Sachses, all the JP Morgans. They have to start with this because of the old philosophy that you had to be diversified. Well, in 1940, when this all started, as far as funds go and as far as portfolio management goes, there wasn't another option, and it was all on paper, and people were moving very slow, and the traders were making all the money, and the investors weren't. That's all gone now. There's no cost to invest anymore, which is pretty insane. And I can go into detail about that in the future, about how they make money when there is no cost, but we'll get there. The point is that this sucks. This is the way everybody's been doing it. I did this for 15 years, but I created my certain strategy on the side. And that's the one I sell to you and the reason I'm on here on the internet. But basically, this sucks because, so these are all the red flags. So if you're on a dating app, these would be the ones that the girls dislike you for, right? It's designed in 1912. In 1912, there was what, like 600 publicly traded companies, maybe? And some of them were so small they only made $15 a week, and some of them were so big that they were a Vanderbilt company that made railroads. So they had to map it like this, but you don't have to map it like anymore. There's so many stocks. There's over 10,000 just mutual funds. There's almost as many mutual funds as there is stocks and ETFs. This is all meant to get any investor straight to the middle. We want you to retire on time, but not too early. We want you to be not too risky so we can basically make a market for all these nameless, faceless, shitty stocks. You don't have to do that anymore. These are only based on market cap. Market cap is the size of the company, not on physical size, not how many desks and buildings and parking lots they own. This is the stock price times the amount of shares outstanding. I actually think I wrote that down here. But the fact is this is just absolutely antiquated, and it's so easy and it's so obvious and it's right there. But the industry is stuck on it because the sellout advisors who just sit there and click buttons and take your 1% a year, they think that this is great. Why wouldn't they, right? And they have Congress, and they have all the security agencies underneath them, NGOs, right? That dictate how this has to be done, even though that is like wiping your rear end with a leaf rather than toilet paper. These don't matter. The reason I'm saying these don't matter is because it's market capped. It doesn't take into account the type of the business, which I just explained to you. So if you knew restaurants are going to do well because food price commodities dropped, like pork belly and beans and corn and everything that could possibly beef, side of beef, well, maybe you want to buy Sweet Green, right? But you don't want to buy the Bunner Company. Maybe there's something going on with them. Maybe there's a problem or an issue, or there's somebody died from taking their medication, right? You don't want to own them all. You don't have an opportunity to not own the bad stocks when you map it like this. Tomorrow is going to be the fun time and the fun day, and I'm going to show you exactly how it's done, and it's 1 billion times easier than this. It will be a paid subscription. So you have to be a paid bull. It's 20 bucks a month. That's my service. That's what I do for a living. It's 200 a year, and prices are going up in the new year because we beat the market by over 10%, 13 out of the last 15 years. This is good. What I'm doing is okay. This is okay. What I'm doing is better. It's truly a nonsensical, no BS, no cap kind of service. And go subscribe. You can watch this. I said everything out from economic, diagrams of how we're doing, all the way down to the exact individual stocks that I professionally professionally trade, and also the very ones that I used when I was managing $1.6 billion at Fidelity. So get your ass over to everbullish.substack.com, and you can sign up for all of these trading lessons and everything else. There's a free option where you get this content, but you don't get the picks. And then there's a paid option where I give you literally everything that's necessary with no fluff on how to whip the market's ass and go kick some ass, go live your life. Don't care about this stuff because it'll be growing, and you can go out there and live your life and have some fun and retire early. I'm Chase, everbullish.substack.com. Go subscribe. And just have a great holiday season. We'll see you.